Good morning, and thank you for joining us for the August 27th, 2024 meeting of the Chicago Teachers Pension Fund Investments Committee. For the record, I am Jacqueline Price Ward, Vice President of the Chicago Teachers Pension Board Fund and Board of Trustees and Committee, and the chair of this committee. This meeting is being held in person at our offices at 425 South Financial Place. The Investment Committee is a committee of the whole and includes all CTPF trustees. A quorum for this committee is 7 trustees on site. Right now, we do not have a quorum. Also, we do not have anyone for a trustee for remote attendance, so we don't need to do that. All participants, please wait to be recognized by the chair before speaking, and please limit discussion from each trustee to 3 minutes. Please know that our staff and trustees will focus on the business of the meeting. We will not be responding to messages from participants using the Zoom chat feature. Please forward questions to memberservices@ctpf.org. At this time, we will move to public participation. We now will have that public participation. Do we have any members for public participation? Thank you.
Yes, Ms. Tina Padilla on Zoom.
Good. Tina? Okay, I see her. Tina, are you there?
I'm here. Trustee
Okay, great.
Price Ward, thank you very much. I'm going to put on my timer.
Okay, thank you.
Timer, I think. Okay. First of all, again, hello to everybody. I heard you don't have a quorum, but still, to all the trustees and fiduciaries in the space in person and everybody who's online. Thank you for being fiduciaries to our fund, because this is very near and dear to my heart, as you can see. So I'm here today to talk about diversity. At the board meeting, every trustee had a question about diversity, and I too also have a dream, and I'm working very, very hard that one day we will not be judged by the color of our skin or the gender, but by the content of our character. And I'm working very, very hard that after fulfilling our duty, our public service duty to the students in the city of Chicago, that one day we have our defined benefit pension, guaranteed income that we entrusted to you all to invest in a prudent, but an engine. I know how this works, guys. I was sitting in your seat. I'm with you here. So that part, we also have to diversify within the city of Chicago. I noticed Mr. Reynolds at the meeting stated that he invests lots of money for CPS. That being said, I am doing that project. I'll come in with the numbers as soon as, the staff is built and the numbers start coming in, so that I give you proof that not only diversification within thought, education, experience, all that matters 100%. But also what matters is that we're not so connected to all these other elements that run our city, because I live in the city, and everybody else who is counting on our fiduciaries and trustees we have to diversify also, not so much having the same investment managers, because if one investment manager, doesn't do well, he's not doing well for several pieces of our city, which directly affect me. That's my time. Thank you very much. Love you guys. I've loved you for so long. I can't stop now, if you know the song. Goodbye. Have a great meeting. Bye-bye.
Thank
Trustee Barajas. Present. Trustee Beza. Trustee Blackwell. Trustee Nelson. Trustee Ochoa.
Present.
Trustee Price Ward.
Present.
Trustee Riley. Trustee Rodriguez.
Present.
Trustee Benson.
Present.
Trustee Washington.
Present.
And Trustee Woods. Thank you.
All right. Thank you. As you can tell, we do not have a quorum, as mentioned earlier. So on the agenda, I believe we can go right down to item number 5 for the private credit education and discussion.
We don't have a quorum.
We don't have a quorum. Yes, it is. Yes. Thank you.
Good morning, Madam Chair and members of the Investment Committee. So we are beginning our meeting with an education session on private credit. We thought it's a good idea to refresh the discussion on private credit, since it's been a while since we've brought it up. But our goal here today is twofold. One is to address any questions regarding private credit in general. And second, we want to explain, after Callan does their education session, our plan to bring in finalist candidates. But first, a review of how we got here. As you know, in 2023, you approved a new target asset allocation, which primarily lowered international equity and increased fixed income. And if you recall, we wrapped up those searches for those two asset classes. In addition, we carved out 3% exclusively for private credit. We conducted the search earlier this year, and that search generated over 100 responses. And so naturally, given that volume, it took us a few months to sift through all those responses, and we were able to narrow it down to about 25 to 30 semifinalists and conducted due diligence interviews with every single one of them. We are finalizing the pool of candidates to bring to you later this year. Our goal is to build a roster of anywhere between 8 to 10 private credit managers that will give us a pretty diversified portfolio. So with that, I will turn it over to Callan, Pete Keliotis, who heads up their alternatives practice, to review private credit and the pacing plan as it stands today.
Thank you, Fernando. Good morning. Great to see you all again. You may recall I was here about a year and a half ago when we first started the program, or the allocation, to do some private credit education. So it's great to have a chance to cover that with you today. And so, as Fernando mentioned earlier, there was a 3% allocation that was approved that equates to about $375 million in potential commitments to private credit. And so I'm on page 2 of our presentation here. And what we're planning on doing is, diversifying this allocation across several managers and bringing 3 groups to the board for approval over the next couple of months. And so this is intended to be not just diversified by strategy type, but also diversified by manager and also manager ownership. And so a big focus of the program, as we're looking to develop it, is by utilizing emerging managers as part of this portfolio. We think this is a good opportunity to add to our allocation to emerging managers. On page 3, we're walking through here. What is private credit? The slide before this one, please. Thank you. And really, as an asset class that's appropriate for institutional investment, it started kind of after the global financial crisis back in 2009. And so what happened was a lot of banks that were active in doing lending to what are called middle market companies, which are companies with earnings between 10 million a year and 100 million a year. They sort of stepped back from that lending practice, partly because of regulations that came down from the federal government, and partially because of from a risk control. They didn't want a lot of lending on their balance sheets. And so as banks stepped back from lending practices, non-bank lenders or private credit lenders stepped into that vacuum and provided essentially bank lending to the same middle market companies, but instead of being done by banks, they were done by private companies. And so as part of that process, the institutional investor communities such as yourselves stepped in to provide capital, to provide lending to some of these same companies. And types of banks that used to do this kind of lending here in Chicago, kind of Harris Bank, which is now, of course, BMO, American National Bank, Northern Trust, they were all very active in providing the same kind of lending that we're looking to provide here. Also, outside of banks, some names that might be familiar to you: Household Financial, Heller Financial. These were all companies based here that did a lot of consumer lending. And so not only are we looking at potentially providing lending to companies, but also providing lending to consumers, in the same way that some of these companies used to do. One thing that's happened more recently in the last couple of years is interest rates have moved up a lot, as we're all aware. And so that has created an opportunity for private credit to capture that same higher rate environment for the benefit of investors such as Chicago teachers. On the next page, we talk about the size of the private credit market. And so you can see on the left pie chart here, public and private assets totaling about $262 trillion. And that's just a huge number. But looking at private credit as an asset class, about 1.3 trillion. This is as of about a year ago. Right now, it's gotten closer to 2 trillion since then. But the point to be made here is private credit, while it's a growing asset class and actually a large asset class when it comes to the actual dollar amount, it's still relatively small compared to total public assets being traded in the broader market. So we just wanted to give some context for the size of the private credit, broader private credit industry. On the next page, page 5, we're looking at what our return expectations are for private credit. And so one of the reasons why investors look at private credit as an opportunity is because they deliver an attractive return, not just on an absolute basis, but also on a risk-adjusted basis. And so we're comparing private credit here in the middle of this table with a 7.4% return expectation to high yield, so that's part of your core plus allocation, and also relative to private equity. And you can see it's in between the return expectation that we have for high yield and for private equity. So higher expected return, more yield than high yield fixed income, but lower expected return than private equity. But when we look at the volatility of private credit, that's shown on the next page, page 6. And you can see the chart here shows both expected returns on the y-axis with expected risk on the x-axis. And you can see private credit in the middle of this chart, again, in between equities on the right and fixed income on the left. So on a risk-adjusted basis, again, we think that private credit is an attractive asset class relative to other public asset classes. And then on the next page, looking at different types of private credit strategies. So we like to divide the universe of strategies into 3 main buckets. And so as we were going through the search here, we kind of utilize the same sort of thought process, with core being more direct, what we call direct lending, which is senior debt. And by that, I mean much less likely to have losses than other types of private credit. So when we look at one of the metrics that we look at when we're evaluating private credit strategies is how much money did you lose in loans that you made to your companies? And so on average, these are well less than 1% per year in direct lending. And if you compare that against, let's say, high yield fixed income, that's more like 4 to 5% per year. So much less likely to lose money in direct lending than in other areas of credit. And so that's why we like to have that as the core allocation in the private credit portfolio. Other areas of core exposure might be real asset lending. So lending so that you could purchase, let's say, real estate, commercial real estate properties or residential real estate properties, or on the specialty finance side, that's more consumer lending. So lending to for credit card receivables, auto loans, student loans, and the like. Opportunistic, that's the middle bucket. Those are strategies that tend to be more dependent on where we are in the credit cycle. So like if we're looking at a time like today where the economy is doing well, unemployment's relatively low, there's not a lot of opportunities in what we call distress because things are going pretty well and there's just not a lot of companies that are going bankrupt, for example, or having trouble where you might have an opportunity to benefit from that. But there might be times like 2020, for example, during the COVID dislocation where there's a lot of economic turmoil. And so some of private credit strategies are designed to take advantage of times like that, where you've got turmoil in the broader economy. And so when we look at returns, while you might have more likelihood to lose money in opportunistic strategies, you also have an opportunity to generate a lot higher returns and benefit from that dislocation. And so as a comparison in terms of returns, core private credit, we might expect to return somewhere between 7 and 10%, maybe a little bit higher today because rates are higher. But if you look at opportunistic by comparison, that might be expected to return like 15%. And what we saw in strategies that invested during the COVID period, they're generating more like a 15 to 20% net return. So the idea of opportunistic is to not only diversify relative to core, but also capture higher returning opportunities that are out there. And then niche, the third bucket, these are more sector specific strategies. So strategies that are designed to provide lending in very specific areas of the broader economy, like aviation finance, for example, or you could have strategies that are designed to lend to shipping companies. So what we're looking for in this part of our search is not to really invest a lot of money in kind of niche strategies because it can be really hard to find managers that have kind of like a long-term expertise in generating returns there, though those might be complementary to the core allocation. Here, we're looking at really focusing on more well-diversified strategies and the core part of your portfolio. On 8, we're showing kind of that core satellite construct. And so the core portfolio, again, would be more direct lending oriented strategies, low likelihood of having credit losses. That's going to be the primary focus of your private credit portfolio. And then we would have satellite allocations to complement that. So we're talking about having an opportunistic allocation. That's going to be, we're going to have managers that are focused on opportunistic lending. That's one satellite to complement the core allocation. And then the other would be what we're calling asset-based finance, or again, lending to consumers or other strategies where you might have assets that are more real asset related, like, again, automobiles, homes, commercial real estate. On the next page, on 9, we're talking about the program development for the private credit allocation. And so it's kind of a lot of words on this chart, but I just want to walk you through where we are in the process of developing the private credit portfolio. So on the top left, program design is really, what is it that the private credit portfolio is designed to provide to the broader fund? What does the oversight look like in terms of that portfolio? What are the roles and responsibilities of different parties involved in establishing that private credit portfolio? That was all discussed prior to the target 3% target allocation being approved. So that already happened in the past couple of years. On the top right is strategic planning. That's the next step. And that's where we get into, okay, if we have a 3% target allocation to private credit, how are we going to implement that target? How many managers are we looking to allocate to? How do we want to budget capital over a period of time? And what kind of vehicles do we want? And by vehicles, we mean, do we want something that's going to be an evergreen structure so that we can invest anytime we want? Or are we looking at vehicles that are more of what we call a closed-end fund structure, which means you can only invest in certain times when those managers are coming to market to raise a fund. So, and what kind of liquidity do we need out of the private credit portfolio? So those decisions are actually happening today, kind of ongoing. That, you know, this is kind of over the next couple of months, we're going to be really honing in on not just what the dollar amounts, which we've already decided, but also how many managers are we looking to bring to the board for approval. And as Fernando mentioned, 8 to 10 is sort of the number of managers that we're targeting here. The next step, manager selection, is exactly which managers do we want to retain to implement the private credit portfolio. And again, that's currently underway. We'll be bringing managers to you over the next couple of months for your approval. And so that's where that manager selection step. And so the idea of manager selection, of course, is finding managers that have experience investing in private credit, have a track record investing in private credit, are doing it in a fee structure that's competitive. So we don't want to overpay to get exposure to private credit managers. And do they each individually bring strong returns and strong diversification to the broader portfolio? Are they complementary to what we're doing at the broader private credit portfolio level? So that's, again, that's currently underway. And then lastly, monitoring and evaluation. So once those managers are retained, just like you do with the rest of your portfolio, we're looking to make sure that the performance is in line with your expectations, that there's no organization issues to be concerned about. And if there are, what are the steps that we can take to make sure that we're not facing excess risk in manager selection? So that's going to all start in 2025 and beyond once those managers are selected. And then it's kind of a circular process. So after monitoring, we go back to, okay, so is the portfolio doing what we expected during that program design step? You know, is the performance in line with what our expectations were? Page 10 just shows some kind of different return metrics that we use to measure performance. Didn't plan on spending a lot of time here, but happy to answer questions. All I would say is when it comes to private credit specifically, our focus is on internal rate of return, which is about kind of like the fourth one down, which is what are the short-term returns that private credit managers are delivering to Chicago teachers. And then so looking at portfolio implementation, so on 12, we went through this with the board a few quarters ago when we first had the 3% target approved. And so as you can see, there's different subcategories of private credit that we're looking to allocate to. I mentioned before the three main buckets: core, opportunistic, and niche. And so this table gives you a sense of what the allocation guidelines are, or the ranges that we're looking to allocate to each of the different subcategories of private credit. So you can see these ranges are fairly broad. We want to make sure that we have some flexibility in implementation. You know, it's hard to rebalance within private credit managers because you don't have the same liquidity that you might in core fixed income. You know, these are private loans, so you don't have as much liquidity, and that gets in the way of being able to like change your allocation targets that rapidly. But this just lays out diversification by strategy type and diversification by, again, by manager, as I mentioned before. And then at the bottom of this table, you can see these are our longer term expectations for the portfolio. So we're expecting about an 8 to 10% return from the portfolio that we're looking to implement here. Most of that return is going to be coming from current yield. And the reason why that's important is we're not looking to get returns from like equities where there's a lot of volatility from month to month. You really don't know what the returns are going to be in one quarter or another. Here, these are contractual cash flows, so you know exactly what these coupon income is going to be. And so that's going to be the bulk of your long-term return in private credit, is being generated by more certain cash flow by private credit managers. And then it provides expected volatility at the bottom. So volatility, again, in between fixed income and equity. And then page 13 just shows the implementation strategy. So the last time that we went through board education on private credit, we gave you a few different options. Do we go directly? Do we go through a fund-to-fund structure? The consensus was, let's just go directly and hire managers directly through a search process, which is, of course, underway. And so we just wanted to refresh the board's memory on exactly what that implementation strategy looks like. So you'll be implementing a direct portfolio with the advice of the investment consultant, working with the staff to select managers on your behalf. And then the system is responsible for handling the legal and the tax and the audit and the administration of that portfolio. And so you've decided not to delegate that to a fund-of-fund manager so that you could have more direct control over the structure of the program and more direct control over which managers get selected to implement the portfolio. So it's a little bit more complex than what some other strategies might be in terms of implementation, but the benefit is control lies with the board and with the staff, and the fees are also considerably less than if you went through a fund-of-funds manager to get exposure.
Susie, can we ask a question or wait till?
We'll wait until they're finished. You make a note in your.
The next page on 14 just talks about there's different types of vehicles, as I mentioned earlier, to get exposure. You could either do a drawdown vehicle or an evergreen or open-end vehicle. The point to be made here is simply that when we went through the process of structuring the core opportunistic and asset-based parts of the portfolio, we thought it would be helpful to have some exposure to evergreen. And the reason for that is evergreen strategies, you can make commitments anytime, and if you want to reduce your exposure to a particular strategy, you can basically just not participate in future investments that strategy makes. And so you're allowing your exposure to kind of run down over time. It just gives you more implementation flexibility. And so when we're looking at how to structure the broader portfolio, we thought evergreen on the right side of this table would be a good way to get some of that core exposure, and with the idea that the other areas of the portfolio would be done more in kind of drawdown funds. Again, just to maintain flexibility and implementation over time. And then on page 15, this was the pacing that we laid out with the board back in 2023. So you can see different colored bars on the top chart. The dark green are the evergreen funds. Again, was intended to be a lot of the core allocation would be in evergreen funds. And then the drawdown funds would be more complementary to the core evergreen allocation. The reason why this matters is only that not all private credit managers have a fund that's available in an evergreen structure. If they did, we would probably want to do everything in an evergreen structure just so we have more flexibility. But because some only have funds in a drawdown structure, the idea is we'll use evergreen where we could, and then have drawdown structures to complement the evergreen exposure. And then the bottom part of the page on 15 just shows what the ramp up looks like in terms of when we're looking to get to our 3% target allocation. So it's going to take a few years. The expectation back in 2023 is maybe by 2027, we would have our 3% target allocation achieved. We're hoping to maybe get this done a little bit quicker than that, depending on who we end up with in this portfolio, but nonetheless, it'll take about 3 to 4 years to get to our full target allocation. And then so on page 16, just kind of a summary of what we're looking for in this portfolio. So again, evergreen funds, those open-end funds are designed to provide some implementation flexibility without the need to always have to make a reallocation decision by the board. We're looking at direct partnerships as the structure of the portfolio rather than investing through a fund-of-funds manager. Diverse and emerging managers being a very significant part of the portfolio. That's been considered in all the manager selection decisions that we've been making so far. And we are looking to have a relatively concentrated portfolio of 8 to 10 managers. We don't want to have like 30 managers to implement this portfolio. We're looking at about, somewhere between 8 to 10 again in terms of managers, and we're looking at about 30 to 50 million per manager as part of that portfolio. So that's just the summary of what we're looking for this portfolio. And the next section has to do with Callan's role in working with the staff to identify good managers. Wasn't planning on going through this in a lot of detail, just to point out that when we go through our search process, like on page 18, it's a very consistent process. We've got, we're evaluating each of these candidates. As Fernando mentioned, we had over 100 responses to the search. And so we go through a very disciplined process to identify which of those candidates we think are best in class within the 3 buckets that we're looking to allocate here. So just wanted to cover that real quickly. And with that, happy to answer any questions.
I'm waiting for the chair to.
Okay, all right. Is that the conclusion? All right. So now we will have questions. Yes.
Okay, so my question on page 13, when we're talking that you felt that the best plan for us would be if a CTPF direct portfolio, at the chart at the bottom right-hand side, CTPF legal. So would be our legal team here would be managing that, or one particular person? Is it the whole team, or am I interpreting it incorrectly?
Maybe you should.
So in this case, we have one person assigned to our team. It's not the full legal team.
Who would that person be?
Usually, Becky, you usually do the contracting for us for investments, right? So, yeah.
And so what would be your role, Becky?
So I would handle any of the contract review and negotiation as the internal investment counsel.
Do you have any past experience with any of this, or have you had any special training?
Yeah, I've been, since John Schomburg left, he was formerly the person assigned to the investments department. So it's been since about, I think that was 2019, when I took over as their assigned internal legal.
I guess what I'm looking is in particular anything with private credit.
Okay,
So-
Maria, let me come back to you. Let me see if anybody else, because that's 4 questions in one. So,
Or,
yes,
okay, I'll look at.
yes, go ahead, trustee Ochoa.
I didn't catch the difference between the regular funds and the,
Turn your mic up. You will pull it up.
or just talk into it maybe.
Yeah.
I didn't catch the, what makes the difference with the evergreen and the drawdown. I didn't understand. If you could please explain that.
Sure, no problem. Thanks, trustee. Just real briefly, so a drawdown fund, the way it works is a manager is going to come to the market and say, okay, we're looking to raise, let's say, $100 million fund. And so are there investors that are looking to participate in that fund? And so once that fund closes, usually they have about a year to raise the fund. Once that fundraise closes, then if you're participating in that fund, if they need to call capital to make investments, you basically are obligated to provide that capital to fund new investments as the fund is being invested. So typically there's about a 2 to 3 year investment period at the start of a fund, where for that next 2 to 3 years, the manager's out there finding companies to invest in, underwriting loans. And as those loans get originated, you as the investor then, they'll say, hey, Chicago Teachers, we need $5 million to go ahead and make this loan. And so you're obligated to then provide them with money to go ahead and make that investment. And so once those loans once those loans mature and the proceeds go back to the fund, then you get the proceeds from that realization from the distribution that comes from those investments back to you as the investor. And so the reason why it's called a closed-end fund is once the fund is closed and it's not accepting any more capital, you can't get out of the fund. There's no kind of liquidity opportunity to get out of that fund. You're basically in the fund until all the underlying investments are realized and proceeds are distributed back to the investors. And that usually takes about a 5 to 7 year period, depending on the manager. So you can think of it as you're basically in that fund for about 5 to 7 years until all the proceeds come back to you as the investor. That's the closed-end fund structure. And that's how most of private equity works and most of real estate works on the opportunistic side. On the open-end fund side, the evergreen side, the way it works is that manager's essentially always open. So you can basically say, hey, I'm going to contribute to this fund this year, or I might make an additional contribution to the fund next year or the year after that. They're always accommodating new allocations by investors. When it comes to the back end, in terms of liquidity, what they'll typically say, and everybody's a little bit different in terms of how they structure evergreen funds, is, okay, if you no longer want to make an allocation to our fund, once we sell loans that we've made previously, you'll get proceeds back from that, from those sold securities, but you're not participating in any new investments. So the good thing is on the front end, you've got a lot of flexibility in terms of when you can allocate to that fund, but you still have to wait until investments are realized before you can get dollars back to you as the investor. So there's some open-end funds where they might have cash available to fund, what they're called redemptions, is the request for liquidity. And so they might say, okay, you don't have to wait for investments to be sold. We can just write you a check right now for whatever money you want back from the fund. But most evergreen funds, the way it works is on the back end, once investments are realized, you have to sort of wait for those to get distributed back to all the other investors in a fund structure. So you can think of it as just less flexibility in when you can make investments for a drawdown fund structure. You have to just do it as the fund is in market. Where on the evergreen side, you've got more opportunities to invest throughout the life of the fund. I don't know if I'm being clear, but
Well, I think you explained the evergreen. I mean, it sort of keeps giving it, so keeps looping around and
keeps looping around.
benefit from it. And the other one is just one way, and you have to wait till it
Exactly. And so
cycle. Yeah.
and so you have to wait another maybe 3 years before you have an opportunity to invest in the next fund and the next fund. And so it just requires a little bit more kind of planning ahead of time to participate in those. And also usually you're going to have to make a board decision to reinvest in that fund, where once you, just like on, let's say your core fixed income, once you've selected a manager, you're not having to revisit that decision every couple of years. In a closed-end fund structure, you're having to revisit that decision every time the manager is back in market with the fund.
Okay. Thank you for the explanation.
Executive Director.
Yes, just along that vein, can you talk about, Pete, how the fund actually makes money with the private credit structure, since the redemptions for close-in seems like it's when it actually closes, and then for the evergreen, it's just depends on the structure. Because generally with a loan, there are payments that are being made, so none of those payments actually come back to the fund until there's a close. How does that work exactly?
Sure. So let's look at like direct lending as an example, because that's the most maybe the best representation of how private credit works. So regardless of whether it's a closed-end fund or an open-end fund, if you, let's say I'm the manager that you've hired to implement the portfolio, right? And let's say you're going to give me $100 million roughly to go out and make investments. I'm going to go out, I'm going to basically find companies to lend to. And as part of that process of lending to companies, I have an agreement with that borrower. Typically it's a 5-year loan, right? And so the agreement consists of what's the term of the loan and what's the coupon that I'm going to get for making that loan. Nowadays, it's about, SOFR plus kind of 6 to 7%. Okay, so that equates to about kind of 10 to 12% coupons that I'm getting in exchange for giving you a loan, right? And so how you make money is you collect every quarter that, or every month in some cases, that borrower is going to write you a check for what the interest is on the loan. Just like if you're taking out a mortgage, you have to write a check, for your mortgage amount. So there's two ways to make money in this direct lending example that I'm giving you. One is that quarterly coupon that you're getting back from the borrower. That coupon, in some cases, gets distributed back to the investors. So you don't necessarily have to wait until the end of the fund to get cash back from your investments. A lot of private credit managers will distribute that quarterly coupon income to investors. And so it might be a 6% annual distribution of coupon income. That might be an 8%. It just depends on the strategy. But many of them will distribute on a quarterly basis that coupon income. In other cases, they might take that coupon income and rather than distributing it to investors, they might go out and make new loans with that coupon income and reinvest. And it's called recycling. So, rather than distribute that coupon income back to the LPs, to the Chicago teachers in this case, we're going to go out and use that coupon income to make new loans. The benefit of that is while you don't get coupon income back during that the holding period of the loan, you can make more money, just like it's like a dividend reinvestment plan that you might have in your retirement income fund, right? So rather than getting money back from your investments, you're reinvesting in new investments, and after a 5-year period, you've got much more money at the end of that period than you otherwise would have if you were getting those coupons distributed back to you to invest in other things because they're being reinvested. So, yeah. And so, and the other way of making money is, and this is what a lot of managers will do in the opportunistic bucket that we were talking about, is they might find companies that have loans that were made previously that are available in the secondary market. They're being traded amongst other investors. And you might have an opportunity to purchase a loan at a discount, 10% discount, 20% discount if the company's undergoing some issues or just if there's more dislocation happening in the broader economy. And so you can make money not just from the coupon income that you're getting from the loan, but also by purchasing loans at a discount from other lenders that no longer want exposure to that same company. So there's opportunities to pick up return from the secondary opportunities too.
I had a question about the respondents. You said there was 100 and you narrowed them down to 25. Will there be another narrowing down? We won't be seeing 25. Okay. So, but we're not at that place right now.
So we started. So we narrowed down to roughly 25 to 30 semifinalists, and then we interviewed all of them, and so we're bringing in about 12 out of the 25 for finalist consideration. So that's, if you will allow me to just delve a little bit into the logistics. I think what we're looking to do is bring them all in 3 subsequent meetings sometime in October. We're targeting the October 1st Friday because originally anyway, we were looking at this October 1st Friday to bring in private credit managers. So we said, well, why don't we take the opportunity to use that to bring in finalists since it's an investment committee meeting anyway. And we'll bring in 4, I believe, for the first one, which is core/direct lending. These are our 4 highest conviction managers out of all of the core direct lending managers. So you can accept all of them, part of them, or none of them, depending on how they net out and answer questions for you. But these are our highest conviction managers for core and direct lending. And so following that, we are targeting also the October board meeting to bring in opportunistic. And then we also have one more investment committee meeting, October 29th, I believe. And that'll round out the third group that's asset-based finance.
Okay. Speaking of the core direct lending and the opportunistic, on page 12, would that be the allocations of the 3% investments and with all of these strategies, correct?
Yes, sure. Roughly. So we're not necessarily looking to allocate to every single subcategory here. with specific managers. The idea is once we assemble a group of managers for the portfolio, you'll get exposure to all of these through the managers. So each will have diversified portfolios, and some might have both large market direct lending and small market direct lending in the same portfolio. So you can think of this as what your total portfolio will end up looking like, but you're not picking managers necessarily in each of these subcategories.
Okay, thank you. And it depends on the manager. Yes, trustee.
So, I don't know, this is a weird question. So the recycling process, right, that you were talking about. So what mechanism exists to help us protect ourselves in the recycling process? Instead of receiving returns, they might recycle them, right? Into what mechanism exists to help us from bad or predatory business investments? How do we do that? How do we protect ourselves?
So one of the things that we do when we're looking at any of these managers is what their past lending practices have been. And so if there's any managers that have had a history in providing lending to companies that, what you're talking about, like let's say payday lending or things like that, we would exclude them from consideration for this search. So we're very strict in terms of, okay, are they, middle market companies that are not having any practices that are any kind of issues from an ESG standpoint. We're very careful in making sure that we understand exactly what companies they've been lending to historically. There are some lenders in private credit that have origination partnerships with companies that do predatory lending, and so we've excluded them from not just this search, but also from Callan's database as well. So that's part of our due diligence process, and also working with the staff is to make sure that that's not been an issue. And so one of the things that we talk about with each of these manager candidates when we're doing the interviews that Fernando mentioned is, okay, so exactly what sectors are you lending to? We have a list of companies that they have lent to historically that we review. It's incumbent upon us to make sure that they haven't had any predatory lending practices historically. And then going forward, on a quarterly basis, we review their financial statements to make sure that are they making new loans to any companies that might be concerning. So it's not just looking at past behavior, but also behavior going forward. One thing I would note, though, that is we don't have separate accounts that we're setting up in this portfolio. These are all commingled funds, so we don't necessarily have much control over the exact loans that are being made by these private credit managers. So we're delegating that responsibility to the private credit managers, but we are doing that monitoring on a quarterly basis after the commitment gets made to the manager.
Yes.
Sorry, just to add to that, one of the big areas that we purposely avoided is if a manager is investing in traditional energy and keeping with our goal towards offsetting and or divesting, we said no to traditional energy.
Trustee Washington.
Thank you. And to that point, the question that sprung in my head is, so as we're picking managers, excuse me, we generally know the types of investments that these managers invest in. So say if they're investing in something that the board may not, something that we have divested in already, or to the point that you just made, we're not trying to get into further traditional energy. So, but we would know these things before allocating to them, correct? Like we wouldn't, we think we investing in McDonald's and surprise, it's Walmart.
Right.
That type of thing. Okay.
Yeah, we've delved into the history of the prior investments that they've made. That really tells us a lot about what they're looking to do going forward. But we also asked them going forward what opportunities look enticing to you, because there are a lot of managers, like I think if the oil and gas industry tomorrow became distressed, would be very appealing to them. But we've told them that's not something that's appealing to us. So
to that point, it's not appealing to us, but we've signed with them and they've said originally that's not something they was going to do, but then life happened and all of a sudden, you know, oil and gas is burning all over the globe and they want to get some of it. Is there something contractually in what we put in place with them about where they're putting our money? So like, if they're investing in that, how does that impact our fund? Because if we say we don't want our money in oil and gas, but then they decide after they've gotten our money under contract, well, we kind of think oil and gas is a good thing. What is the remedy for that? Or is there a guardrail for something like that?
Yeah, so there, unfortunately, Trustee Washington, there isn't anything we can do in these funds because they're not separate account structures. So if they decide to change their mind, to your point, and say, you know what, there's opportunities, we want to take advantage of it, we can't really, there isn't really a remedy for those particular strategies other than just not continuing to reinvest with that same manager. So that's part of the reason why we like the evergreen structure, is because if we're, for whatever reason, not comfortable going forward with that manager, we just choose not to continue investing and letting the legacy fund, legacy investments that they made kind of roll off over time. But these are all commingled funds, so we don't have direct control over the types of loans that they're going to be making going forward, and they're not going to be able to. They're not going to be able to set up a fund structure to avoid specific areas. We can only, as we're entering into these agreements, make sure we're focusing on managers that historically have not invested in those areas of concern.
Great. Trustee Rodriguez, you had other questions?
Yes, I do. Okay, going back to page 13, I know I asked about who would be the legal and do we have any experience, anybody in legal department? But still my concern, the program can only be as successful as long as all you could, the program would only be successful through implementation. And we've decided, and that's not a question, we have implementation of a direct program. But then again, when I look at page 13, still not a question, under cons, it says implementation complexity, operations, legal administration, specialty consulting fees. Okay, so that's the first one, specialty consulting fees. Would that be to Callan, or would it be because we're self-directed that we would hire someone else for that?
Trustee Rodriguez, that's really more if you were going to have such a large program that you needed to hire a dedicated consultant to advise the board, but that's not, in the Chicago teachers portfolio, you're not having to hire a separate consultant to do that. So it's
Put
really
it in there next time and I'll save you the
Okay.
time. I'll spare you the question. Okay, and so pretty much so, but the legal, and second question, so the legal department would be beyond just reading contracts, there are other, or not? That's
No, so ingoing, really, we rely more on legal for the contracting stage, and any amendments to the agreement we bring to legal. But in terms of like the actual operations of the fund, they have their own legal, and that's we don't get involved in that. It's really going in. And as they're making investments and they have to amend something with the agreement, we bring that up to back to our legal.
So if something went wrong, question number 3. So if something went wrong, who would be responsible? Would we be held accountable because it's a direct no?
No, because we,
So who
again,
would be?
the manager would, because they were the fiduciary to us. So they would be held responsible for that.
Okay, those my 3 questions. I'm going to start
you.
counting. them.
Trustee Washington.
Thank you.
You're done. Thank you. Trustee Washington.
Okay, so I want to go back because I want to make sure that I'm understanding this commingled thing. So I get it that with the commingled, we're going into something that we don't have flexibility within the commingled structure, but I would think that to the point that you made, that in a commingled fund, knowing what the manager generally does. So you all are going to look at their track record, the things that they typically invest in to align with ours. And so, and I guess, and not to beat a dead horse, but maybe beating it a little bit, I just want to be clear that if we are clear that, and that they are clear that we're giving them this money with the intention of it going down this certain street. And then if they turn around and go back the other way, I don't know if there are no guardrails. I don't know that.
Mhm.
I don't like that, to be completely honest. I don't like the fact that they get our money and then kind of do whatever they want to with it. I mean, but that's part of investing.
Yes, it
So
is.
I get that part of it. But when I say get the money and do, I think that it matters that if you're giving people money to do a specific task
Mhm.
in a specific area, that the people understand that. Now, I get your point. Well, if they don't do it, then we just draw down or don't, then you learn, lesson learned, you don't invest with them anymore. But to me, I would like specific things stated in no uncertain terms going in the door. Like, hey, we all about making sure that our money is making money, but we don't want our money making money on pirate ships. We don't want our money making money in tar pits. You know what I'm saying? Something that's specific so that it is understood. If you put our money in a tar pit or in a pirate ship, you're not getting no more of our money, and we're gonna be mad at you.
So that's what speaking of that, and then Trustee Barias, can't we include in contracting, Rebecca? Can we include in contracting about our policies and practices, or
Yeah, there are certain policies that normally will have attached within the contracts.
okay? Thank you,
That makes me feel better
Okay.
too.
Mhm.
Trustee Barias.
Not to beat the dead horse like Quentin, but since we are commingling funds and they do give confidential presentations, is it possible to know who we're commingling our funds with? Like, is it other funds? Because if it's other funds that align with us, right, that makes us feel a little better. And also together with the other funds that align with us that are in the commingled fund, we could say, hey, knock it off. The rest of us said, knock it off too. Right. So will they be able to tell us that? Will someone be able to tell us who we're commingling those funds with at some point?
Yes, Trustee Barras. So one of the questions that we could ask from each of the candidates is, can you provide us with as many of your other investors for this strategy as possible? And then we could take a look at that.
Love it.
And if I can address the earlier question, Chair, from Trustee Washington. So
Yes, absolutely.
totally understand where you're coming from. I mean, it's frustrating, because you're like, you kind of don't have control after the fact, right? You can only base it on what you've seen so far. But I would say that, each of these managers, they're not dumb. They're not going to go do something totally different than what they've done historically, because they know they're going to get all their other investors mad at them, right? And
Mhm.
it's
And the consultant as well.
and the consultant too, I mean, so I do think that there is a strong incentive to invest in a way that's consistent with what they stated that we're going to do before the fact.
Okay.
So, yeah.
Executive Director.
Yeah, so Pete, can you talk about the benchmark that private credit will be benchmark to? And then also, once it's fully allocated, is there a pacing process at all?
Yes, so Carlton, so I'll grab the second one first. So there is pacing, we showed you that on page 20 or 15 rather. So 23, the full packet. And we'll update this once we get to the manager presentation point. We just wanted to show you this as a reminder of the pacing that we had done before. But we know that, for example, the funds, your total fund size has changed since then, and all that kind of stuff. So we're going to update pacing every year as we're looking to implement the program to make sure that we're still on track for getting to our target allocation. And then on the benchmark, what we typically will use is the leveraged loan, or basically, publicly traded bank loan benchmark with a spread to compensate the system for illiquidity that comes from, investing in private credit as opposed to public credit. So it's leveraged loans plus, remind me, two.
I think so, yeah.
Yeah. So the kind of standard benchmark for private credit would be the Morningstar LSTA, which is just a industry group that represents bank loan providers with a 2% per year premium. And so if the private credit managers in the portfolio don't meet that return target, then we'll reassess whether or not this is still an asset class we want to continue investing in. Yeah.
And just a quick follow-up, the managers that you're bringing in, will we see data comparing them to this benchmark?
Yes, absolutely.
Okay, thank you.
Great. Seeing no more questions, we're almost back on track. 8 minutes, 8 minutes. That's it. That's it. Are there any final questions so that, and then we can conclude this presentation if there are none? Okay. That's great. So now, we can go to, the private equity performance review, and that is Rian. I got it. Nice to see you. Really good to see you.
Good
We
morning.
haven't seen you
everyone.
in a minute. Yeah.
I know, I apologize. We've had a lot of scheduling conflicts, so I'm going to start at tab 2 of the Callan hard copy book, or the private equity performance. And I'm going to start on page 2 of the presentation.
Okay.
So we're looking back at the fourth quarter of 2023. It takes quite a while for us to get this data in because the private equity managers are closing their books at the end of the calendar year. So it takes them a little bit more time to put together their financials. Page 2. Yeah. So what we're looking at here, and we present twice a year on the performance of the private equity portfolio, and generally we don't see much change when we're looking at the metrics because we're looking at the performance since inception, which starts in 1996. And so we're measuring how the portfolio has performed over that period of time. So where I'll start is this kind of second category here called changes in value. The bottom value, the total realized and unrealized value. This includes the net asset value of where you stood at the end of the year, as well as any money that you've paid into the program that has been paid back to you. Okay. So the total realized and unrealized value is about 2.4 billion in assets. So distributed capital, which is 2 lines up, you've gotten back about 1.3 billion. So that's hard dollars, realized returns that you've received from the managers. And then the net asset value where the portfolio stood at the end of the year was just over $1 billion. In assets. And so that represented 8.8% of your total fund portfolio. Okay. We mentioned the target is 5%, and so we're managing our future commitments to get back down to that 5% level over time. So you are a little overweight versus the target.
So we are at 8 right now, but we're working to get back to 5, correct?
Yeah, you're at 8.8.
8.8.
Yeah, so almost
no, we are
9.
at 8.8, but our plan is for
5.
5, but we're at 8 now.
Right. The target,
okay.
yes, the current
The current, yes. Thank you.
Yeah. And then so if we look at performance and we move to the next section, we measure these closed-end funds a little bit differently than the quarterly performance that you see. So what we're looking at here are more ratios. And what we're trying to get to is for every dollar you've put into the program, how much have you gotten back over this time period? And that is represented by the total value to paid in capital. So for every dollar you've paid in, you've gotten $1.62 back. So that's a positive return. That puts you at within the second quartile versus other private equity programs. Again, one of the things we've talked about, and this will take a long time for this number to move, is that you originally implemented with fund of funds. So there was an additional layer of fees in that program, and you've since moved to a combination of direct funds and fund of funds. And so having that direct portion of the program that doesn't have that extra layer of fees is what will help you move into more of the top quartile. But either way, you are above the median for your peers. So it's not poor performance or anything like that, but I just know the question often comes up, how do we get to the first quartile? And that's how you do that. The other number I will point to is at the bottom of the page under additional metrics, that unrealized gain loss. That's basically if you were to compare the change in the value of the portfolio over the quarter, similar to public markets. So returned about 3.31%. Because private equity is a little bit slower to incorporate changes in the value of companies, you typically will trail the public markets when public markets are up, and they were up 12% in the fourth quarter of last year. So it's not an exact comparison, the 3.3 to 12%, but that would be kind of the closest comparison. And what you'll typically see is when the public markets are down 12%, this portfolio will likely be either positive or just slightly down. So it moves in a much more smooth manner. You're not seeing those valuations go up and down. The last number I want to talk about is actually not on this page, but we talked about looking at performance using the public market equivalent. So what that means is for every dollar you put into private equity, we want to know if you put that into the public markets, what would the return difference be? And so by investing in private equity over public equities, you've added an extra 3.21% over the time period that we're looking at here. So that means that you've got that return premium or the illiquidity premium that Pete just mentioned we're looking for in private credit. We're also looking for that here, and that equates to 3.21% for the program.
Great. Do we have any questions, or are you taking questions? Okay. Do we have any questions? Okay.
That's it, yeah.
Okay, that's it. Yes, Trustee Barajas.
So some have described this as like the sweetheart market, right? So do you have any projection of when the honeymoon phase will be over? I don't know what better way to put it. With private equities, because there are many people who are projecting that the honeymoon phase of private equity may be at the horizon,
So I'll try to answer that question. So when you say a sweetheart period, help me with that one.
I don't want to scare people and you say like the bubble's going to bust, because that scares people when you say that. But kind of, I mean that sort of in that phase, know?
So two things I would say. One is there's definitely been slower growth in private equity in the past year than what we saw in previous years. So we're definitely seeing that kind of slowdown period for sure. And a lot of that's driven by when rates went up, it kind of froze a lot of transactions, in private equity and private credit to some extent really benefit when there's a lot of transaction activity in the broader market, because they've got people that need to borrow money and people, that kind of stuff. When that all slows down, as it did when rates went up, it has kind of a cooling effect on fundraising, and it has a cooling effect on the ability of private equity managers to distribute proceeds from sales, because those sales aren't happening, right? So it's kind of a circular process. If you don't sell a company because there isn't transactions happening, you can't distribute that money back to investors. And if that happens, then investors that are in that fund, they're kind of sitting on that same fund. They can't go out and invest in a new fund because they've got the current fund that they're already investing in, right? So it's a bit of a circular process. What we expect now that the Fed has made it clear that they're going through this rate decline going forward, we expect the market to sort of get freed back up again. And we're going to start to see that transaction activity happening again. And we expect that maybe the honeymoon will reemerge in private equity, and so, it's hard to predict exactly what the timing is for that uptick in transaction activity, but I would venture to guess that since the rate declines are going to start hitting in September, that when you look at 2025, kind of, second quarter, third quarter of 2025, it's going to look a lot different. It's going to look a lot more activity than what was the case in second, third quarter of 2024 as a comparison. So I think that transaction activity is going to start picking up. The other thing that affects private equity, especially the venture capital part of private equity, is IPOs. I'm not sure if you're familiar with IPOs and all that, how that works, but like when a company wants to go public and become a new publicly traded company, it's only under certain market conditions that they can get the value for their shares that they are really kind of like expecting. And so what we've seen since rates have been coming up is the IPO market has slowed down a lot, even more so than the transaction activity that we saw in the broader private equity space. And so, but that's also very sensitive to the interest rate environment. So we expect the IPO window is kind of what the commonly used terminology is, is the IPO window open or shut? We expect the IPO window to kind of open up again, mid 2025 and onward, partly because for a lot of these technologies that venture capital is intended to capitalize on, for those to really grow and develop and, for companies to create new products, they need investment, and so if the broader economy is not providing that capital, then those new investments can't happen. Those new companies and new technologies can't happen. So there's a lot of incentive for, if you can't, if you can't get capital from a bank, for you to go to the equity markets to get that capital. So we do expect the IPO window to reopen again in mid 2025 and onward, and we're already starting to see a slight pickup in venture capital-backed companies going to market currently than what was the case like 6 months or 12 months ago. But I think part of your point was the broader private equity industry, is it in a longer-term decline? Forget about interest rates and all that I just went through. Is it in a longer-term decline? What I would say is it's become a much more institutionalized asset class than was the case 10 years ago. There's a lot more long-term investors active in private equity than was the case before. And I think that's healthy for kind of maintaining, a robust private equity investment environment, because there are investors that have target allocations to private equity and are going to stick to those target allocations. Even if they make minor adjustments, they'll still have a long-term allocation to private equity than was the case, during the prior cycle, let's say pre-COVID, coming out of the GFC, kind of like 2010 timeframe.
Take that back to the 5% allocation, that will minimize. Correct. I'm so sorry. So if we take it back to the 5% allocation that we originally had, hopefully that'll minimize our exposure, just in case we're all wrong. So, yeah. Am I correct?
It is a risk mitigation
Okay.
kind of step.
Just to add also, so even though we are continuing to invest, it is a lot lower than previously, but it still keeps us in the market. But hopefully, with the way we paced it, I think we show. I think I can't remember when we get to that 5%, but we're not truly out of the market with what we're doing every year. That's why we could keep coming back with 50 to 60 million, but it's a lot lower. It keeps us in, but then it'll get us back to that 5%. So,
Thank you.
And if I can make a point, Chair,
Yes, you
on that. So what we want to avoid doing is trying to time it too much. So one thing that we always try to avoid in private equity and private credit, for that matter, is timing the market and trying to guess the perfect time to be allocating or not allocating. In private equity, what you want to do is maintain a consistency in allocating year by year, because you just never know that year that you're investing in today, what the performance is going to be, and so you just want to maintain some consistency there. That's all.
Mm-hmm.
Yes, Trustee Joel.
I don't know what can be done about what I'm bringing up from your side of things, but private equity's damage to healthcare has piled up, and that's seems like that's something Congress has to take care of, the FTC, something, but that's been damaging. I don't know if there's anything we can do on our end to try to keep ourselves away from that kind of stuff. But if there is like us to consider it, because it's going to hurt us all if it keeps going down the path it's going. Just wanted to make that comment. If you guys have any response, I'd love to hear it.
So that's definitely something that we're concerned about as well. And we know that, private equity as an industry has had some black eyes because of some of the healthcare related deals that they've done. And if what's happening is by extracting money from healthcare systems to pay investors, by doing that, they're basically starving the hospitals that depend on that money. We definitely would want to avoid that. And so one of the things, just like we talked about during the private credit discussion, is we're very careful in partnering with managers that have not had those practices previously. And so, what we're really focused on for this portfolio is managers that are creating jobs and investing in areas of growth, and not investing in assets that they're just trying to extract capital from, and potentially putting those companies at risk by doing that. So it definitely is something that we focus on during our underwriting process. Yeah.
That's great to hear. Thank you.
One final question from Trustee Washington.
I promise I'm gonna stay out the stable. But while we're on this horse, to that point of what Trustee Ochoa just raised, like as we are looking at, I know that like what you just said, I heard you. And it's kind of like my previous question. Are there ways that we can make sure that, because to be honest, I have very specific opinions about healthcare in general. And I don't believe that healthcare should be monetized in the way that it is monetized, period, or capitalized on. I think capitalism in healthcare is dangerous, because you're gambling with people's lives. And so from an investment perspective, it gives me great pause just in general to think about investing in healthcare, because I fundamentally think that there's something really diabolical about what most healthcare investments look like. Now, don't get me wrong, investing in healthcare from a perspective of, research for innovative types of things, for cancer treatments and stuff like that, that's one thing, development. But investing in the management of an institution or even certain types of insurances, do we cover this or do we cover that? I think those are weeds that make me nervous. And so, because to the point that has been well established, some of these people in private equity aren't doing very nice things as it pertains to healthcare, and jobs are being lost, services are being diminished, and people are being hurt. And so now that I'm off that soliloquy, my question is, so when we're going into these private equity spaces, how much of our stuff do we even delve into healthcare with anyway? And the types of healthcare and stuff, if we are in any of that, because for all the reasons I just previously mentioned.
So we do have exposure in different aspects of healthcare. Maybe that's another possible subject of First Friday down the road, maybe next year, because it is evolving. There are new things that this administration, and who knows what the next administration will do with regard to capping costs for a lot of people, and what, of course, private equity will find some kind of opportunity when the government puts something out there. I can tell you, I don't have the number off the top of my head how much we have exposure in healthcare. Some of the areas that we've been, of course, in venture capital, we have biotechs and drug development companies. In the more mature spaces, we do have, I think we've tried to stay away from managers that rely on payments from the government. I think it's more, we have a manager who consolidates, like, say, for instance, I think it's cosmetic surgery, centers like that, that don't rely again on the government in terms of getting payments. But we are also mindful when manager does bring up healthcare, to dig a little bit deeper into what they mean by healthcare, because it is a lot of different things. So we can follow up with a more detailed analysis of what we own, truly own. And so to just better inform you of what you truly own.
Okay. Thank you.
Thank you. I think that concludes our questions, but I really like that idea because it's very hard. We're working on this on the national level as well with AFT. And it's just very difficult to see the underside of the snake. They only show you what they want you to see. I'll be glad when we can get regulations and then we control our capital. But we need to have full disclosure. And I think that's what we all want, so that we know what we're investing in and it's not the switcheroo or, or all that hidden craziness. But thank you. I like that. You always are responsive to what the board needs. So that concludes this. And now that we have our president with us, I would entertain a motion to go into executive session okay.
Second.
So moving second. And this is for investment matters, section 2C7 of the Open Meetings Act and executive session minute, but we won't be able to, yes, we have 7 now. Yes.
Did you want to go back and approve the minutes and some of the things we missed this morning, or just do that later?
Why don't we, do you want to do that after executive session, or we can go back now and do it?
I was
Joe?
going to have you guys actually do it after. I was going to let you guys let's
Thank
do the
you.
closed session and then do it after. Great question.
All right, thank you. Thank you for that. Okay, so we have had a motion, and the last was executive session minutes, section 2C21 of the Open Meetings Act. So it has been properly moved, and I will do a roll call vote. I'm sorry.
Barajas made the motion. Who second?
Was that you, Trustee Washington? He seconded the motion. Okay.
Okay, roll call. Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you.
Thank you. Okay, at this time, I will entertain a motion. I'm on item number 9. At this time, I will entertain the motion to terminate WAMCO, Western Assets Management Company. And if there are no objections, I call for a roll call vote.
Yes.
Yes. Yes, a recommendation to terminate.
So you still need a motion.
So move.
Second.
Okay, so that was trustee Washington and second by President Blackwell, correct? Okay. So we'll have a roll call vote.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you. 7 ayes.
Chairperson, I spoke briefly to Fernando and the other gentleman that could you please repeat what you just said to me?
So the details of how we're going to reallocate the dollars, we will flesh out in a full motion of a board action request for the September board meeting.
Thank you very much.
You're welcome.
Thank you.
Be better.
Yes, yes. better informed. Okay, now we are going to go back to item number 4. We didn't have anyone for public participation online. So item number 4, approve the May 21st, 2024 Investment Committee meeting minutes. I will entertain a motion.
So moved.
Second.
Okay, so I had trustee Washington and trustee Barajas second. Trustee Washington making the motion, Barajas seconding. Roll call vote, please.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you, 7 ayes.
And that's it, right, Jeff? Oh, executive session minutes. So I will entertain a motion for executive session minutes. And those are as amended because we had a possible spelling issue. And that is for the May 21st, 2024 meeting.
Should be February 27th.
Hold on, wait a minute. Let me pull this because they're attached to this.
February 27th.
Yeah, the February 27th.
I'm sorry. That was an error on my part. I thought what we just voted for was, it was the May 21st. I thought it was for the executive session minutes. So for the May 21st, we're voting on it now, or we just voted on it?
No, we're voting on executive session, and that is Tuesday, February
Yeah, so
27th.
this one I voted yes, but it was supposed to be the no. I thought it was the executive session. I was incorrect.
So I guess, let me just make sure that I understand you. So
Okay.
for the May minutes that were just approved, you actually wanted your vote to be a no,
Correct.
not a yes.
Correct.
Reflect your vote as a no. So it's still approved 6-1.
Yeah, my error. I apologize.
No problem. We all make mistakes sometimes. Okay, so now we're headed to the executive session. The Tuesday, February 27th, 2024. I would like to entertain a motion. Oh, you said so moved? Okay, so
Second.
trustee Ochoa said, oh, so moved. Do we have a second?
Second.
Second by trustee Washington. Roll call vote.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you, 7 ayes.
Okay, I think we are done, right? Well, you're right. I guess I'm in a hurry, huh? Okay, so we are at item number 10, unfinished business. Do we have any unfinished business? Hearing none, we'll go to item number 11, new business. Do we have any new business?
I don't know if it would,
Yes.
if it would be old business or new business question. What happened to the Lincoln Yards? Who was the lucky person who invested in that property?
Oh, that's not on our agenda. We don't know.
They haven't found an investor
I
yet.
thought they had a long line of people. We had to hurry up.
Oh, okay, okay.
Do we want to go back in the front?
No, we don't want to. Okay, so I will,
You know my answer. You know my.
Okay.
Before it was popular.
I just had to check.
and then we don't care.
What?
Okay.
And I didn't care either because that's why I stood. I
Exactly.
wasn't waiting it for it to be popular.
Okay.
I said, no, no.
All
was
right,
no.
Maria.
Thank
You
you.
got jokes today. I like that. Okay. So I will entertain a motion for adjournment. Okay. Your hand is up for adjournment?
Yes, ma'am.
Mhm.
Okay. So Maria
Mhm.
made the motion. And who was that? That you, Vincent?
Oh, Vincent?
Okay, Vincent second.
Mhm.
Roll call. Or do we need?
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Bryce Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
trustee Washington.
Yes.
Thank you.
Okay,
And so lunch now?
I believe